All right, welcome back everyone to Wook Capital Management's weekly Wook in Review. This is Rod Alsman, Managing Director. I'm just need to let everyone know from this disclaimer real quick before we get started with our program. Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Okay, so I have a few prepared topics for today, and then we can get into whatever people want to talk about after. Um, I have my screen share working now. So the newsletter that came out today, which Joe pinned a thread of, is available in the Nest. Um, I'm going to go through the company specific discussions before I go into the macroeconomic discussion. So a little out of order from the flow of the newsletter itself, but let's start with the watch list company highlights. So we had a few pieces of news today, or not today, excuse me, this week on, I'll skip the what would Cohen do first. I'll start with Alibaba. So um, we talked, I think last week, we were talking about um, Alibaba and the uh, breakup of its business and the fact that it's going to let the individual uh, operating businesses basically go out and raise capital on their own terms to try and unlock value for shareholders. So there were two pieces of news this week that I saw that I thought were worth flagging on the Alibaba front. When I had looked at the watch list yesterday, which you can see on my screen, the 1 week change in price. Alibaba closed the last week down 8%. So it was the worst performer on the watch list other than Bed Bath Beyond, which is still there. There's still a few more weeks, I think, until they'll file bankruptcy. But we're not going to waste any time and energy on them today unless people want to. But Alibaba and Tencent were both the worst performers on the Wookie watch list. So the big Chinese tech titans. And the reason for that, for Alibaba, which underperformed Tencent by about 150 basis points, part of it was idiosyncratic. You have, something that I love as a prospective buyer, which is when you have a large seller that's forced to sell, right? That's kind of, going back to some of the readings that we've done over the last several months, margin of safety, going back to Seth Klarman, when you have a forced seller, that is the best situation if you're a prospective buyer, when somebody has to part with an asset at a price that maybe they don't want to. And in SoftBank's case, and they've been selling off their stake in Alibaba for some time. I don't, from the literature I've read, it's not that they necessarily have a view that the forward returns of the business are unsatisfactory. It's more that SoftBank has all these other vision fund related investments that have, many of which have lost a lot of money. And SoftBank had about a quarter stake in Alibaba that just 3 years ago was over $100 billion. And SoftBank's been selling down that stake over the last few years, basically because they have these really significant losses in the tech sector. Their vision fund in February posted a loss of about $5 billion, the fourth consecutive quarterly loss for SoftBank. So, it was an incredible investment. Masa-san invested $20 million in Alibaba in 2020, which it obviously that 20 million grew many, many, many times over. But now SoftBank's reduced its position size. They sold over $7 billion worth of forward contracts against their Alibaba position this week. So they'll be back to just 3.8% ownership of Alibaba, which, in the context of a $250 billion company is less than 10 billion. So, still a great return for that and from that initial investment, but some pretty significant sales. And then broader than just Alibaba specific for why the Chinese tech companies underperformed this week relative to their U.S. Competitors would be this policy news out of China. So this was a story published in the South China Morning Post, which ironically is owned by Alibaba. The headline is China's internet watchdog proposes rules security assessment for AI tools similar to ChatGPT. So kind of your big Chinese tech players all kind of took it on the chin from that reporting. The concern that the Chinese government is going to limit how much generative AI usage or access maybe that the Chinese consumer is allowed to use, right? Because the CCP likes to have complete control over the internet. So, who knows from a practical rollout how much it's going to limit adoption of AI or use cases of AI in China. But it does seem like those two things, the idiosyncratic selling from SoftBank and then the kind of internet watchdog unveiling these draft rules around AI, serve to kind of hold down the valuation of some of these Chinese tech players. So Tencent, as I said, down a little less than 7% over last week. Alibaba just less than 8%. I don't know if anyone in the audience closely monitors either of those companies or the Chinese tech space and wanted to ask any questions about it, or kind of discuss it at all. I'll pause there and see if anyone wants to raise their hand, or Joe, if you had any remarks. Okay, hearing crickets, then I'll move on to.
Yeah, I mean, Alibaba is just not something I look at personally too closely. I will say I added it to the Nest though. If anyone wants to read the South China Morning Post article, it is pinned in the Nest, and it is interesting. It is still interesting to see uh, Chat GPT really. Like, I mean, Chat GPT finds itself in the news all the time now. So obviously, um, it's worth checking out if you're into AI.
I actually paid to upgrade to the $20 a month ChatGPT Pro last night, and I don't even use it much. I just because was curious to kind of see what the difference in responses. You definitely get a higher quality, maybe a little bit more thorough, thoughtful. That word makes sense in the context of a language learning model response from the ChatGPT 4. So if you look at my screen, you can see I'm logged in, and you can see the default, is GPT 3.5, but you can use that GPT 4 if you're a paid sub. So I was just curious. I played around a little bit with it today, but it's an incredible tool, and I know we talked about it in prior weeks that it like whereas crypto has been just a whole lot of hype and a lot of fraud. I think that artificial intelligence in the form of these language learning models is a very real productivity enhancer. Respectively, I'm under my personal account at Rod Alsman been kind of just appending this little AI um, thread. And Joe, maybe you can just pin that one because there's a few useful links. If you just like search under my personal handle AI, you should be able to find it while I ramble on here. But yeah, I mean, it's just going to be interesting to see that the CCCP obviously wants control, and it's going to be curious to see how China native tech players, whether it's Baidu, Alibaba, any non big league players, kind of deploy this, and what happens, right? Because my view is that it can enhance productivity meaningfully for a lot of different use cases. And if China is not going to allow its white collar workers or even other workers to have unfettered access to AI, like what does that do? I'm not a technical enough person to have any deep insight. I can only kind of see that the market reaction was that it sold off Chinese tech relative to how well U.S. tech has performed on some of this news. But yeah, we'll move along then. We can circle back to AI and to Alibaba if people want to later on. Really don't have too much prepared content this week. It's the Alibaba and AI situation that we just talked about, and then secondly, we talked a little bit about this during the Wednesday open mic. I thought it would be fun to bring up again and just see what people were thinking. It can kind of dovetail with the conversation on AI because I know a whole lot of people were using AI to try and suss out the answer to this question, which the question is, as we all know, or perhaps after this conversation, you'll know, the famed meme memester himself, Ryan Cohen, had a tweet this week on the 12th that, quote, I just got off the phone with what was once a great American brand. Lots of problems, no accountability for high paid execs, and little interest in my help at no cost. This could get interesting. So I've seen a lot of different speculation, obviously, on who it is. I have no insight. I've never spoken to Ryan Cohen in my life, so you know, it's not as though we've ever had a conversation. But I know I saw a lot of people on a bunch of different discords that I'm in, kind of, jokingly sharing, hey, here are great American brands. Telling Chat GPT, give me a list of companies that kind of fit this, you know criteria of a once great American brand that has high paid execs and lots of problems. They get a lot of different responses. Some people, right? We talked about it a couple months ago that maybe it has to do with Mark Triton at Nordstrom, right? JWN. There was the reporting in Wall Street Journal initially and a few different media outlets that Cohen had taken a stake in Nordstrom and had some dialogue. The Nordstrom side was a denial of that. There was a Seattle Times article that basically Nordstrom said we haven't talked to him in years. So we'll see. Who it ends up being. There's Nordstrom. Some people were like, "Oh, is it Tupperware?" Because Tupperware was in the news this week, and maybe that. I'm not sure that I think of Tupperware as a great American brand. They certainly have some problems, including I think they had some going concern language. So they're going to have to get some sort of a lift with, whether it's warrants or equity, some sort of a capital raise, I think. But I don't know much about Tupperware. I just know that some people are speculating it was Tupperware, Nordstrom. The Bed Bath and Beyond folks, I'm sure, hope that maybe he's going to swoop in and do something. I kind of think, from talking to you, Joe, that he has no interest, and from your interview with him, in November, that he doesn't really have any interest in Bed Bath anymore. But I don't know. What do you think? And before you answer, I will say, I think there's a non-zero chance it's Playboy. We've had this discussion, you and I, back and forth, kind of like when you look at the top licensed or the top most recognizable American brands, Playboy's the only one in the top 30 that's not a multi-billion-dollar company. Every other one is multi-billion to multi-trillion. So, they fit the criteria. I just have no idea if it's them. Selfishly, I hope it is. But what do you think? And if anyone else wants to come up and chime in, please put your hand up. Come on up. We love to have the speculation flowing on a Friday afternoon. A lot more excited to talk about than me digging into boring macro data, right?
Oh yeah. Let's just speculate. Let's spend the whole 2 hours just speculating on what company this is instead of talking about inflation data. But I do think, based on the conversation I had with him for the interview, he is disassociated from Bed Bath. He probably looks back on it like probably shouldn't have gotten involved. And although he did in the end make money on it, I would imagine he considers it an L because of the hit he kind of took amongst retail investors. His reputation had a bit of a fall, like some irreversible damage amongst the meme stock investors there. So I can't imagine he would ever consider getting back involved in that. So anyone who's clinging on to the hope that it's Bed Bath is really they're out there.
Yeah. Uh, no one, no one else wants to come up and prognosticate.
I'll invite up some of our usual speakers, but I think obviously the most common prediction I've seen is Nordstrom. I see a lot of people saying Nordstrom, but I don't know if that really makes sense given um, personally I don't consider them a great American brand, but hey, some people might.
Hey guys, I do have a theory, or at least a question for the group. Not necessarily on who it could be, but given like the discussion Joe had about Bed Bath and Beyond, do we think Ryan Cohen still has the investor retail pool to kind of boost up a company still? Like if he does end up, announcing one of these companies, does retail still have like the money in the bank to pump it up like we used to see back in 2021?
That's a fair
Yeah, I mean, I think
question.
we've seen. Yeah, I think we've seen with almost every investment since GameStop, like a dwindling effect of him investing, right? Like when he invested in Bed Bath, it went bonkers. But it's subsequent investments, like he started revealing investments in like Netflix and then Nordstrom, and you see obviously Netflix he had next to no impact on. It's just too big of a company, and then Nordstrom really didn't do much when he invested. So yeah, I mean, if it's a small enough cap and it's a company that retail investors can get enthusiastic of, I don't think you're going to see retail really like get behind a company as boring as Nordstrom. And there's like
I
no
didn't
really.
think that people would flock to a company as boring as Bed Bath and Beyond either, but here we go.
Yeah, but Bed Bath has that same um like almost like comedic allure that like GameStop has, right? Where it's almost like funny in a way. And for some reason, you can't underestimate funny when it comes to retail investors. Like Dogecoin,
No, I mean that's
it's just a
the
joke, right?
Elon
And it
Markets
actually,
hypothesis that Matt
yeah,
live in, right? Like he is the meme lord in chief, and him talking about his new X holdings, right? You have a actual stock ticker X United States Steel. So Matt was kind of remarking that anytime Elon is now talking about his X holdings, that it affects the price of United States Steel because of Elon Musk's memery. So you're right. I mean the meme is, I guess, here to stay, but it does seem like the effects of the meming are a lot like with Dogecoin and Elon Musk, for example, right? He changed briefly the Twitter bird on April 2nd, whatever it was. If you see my screen, I think it was. Dogecoin, which again is a worthless cryptocurrency. I say worthless because, I mean, other than it being a trading token, uh, it doesn't really have any real world application, as far as I know. But it sent the price up by 20 something percent. It mostly retraced, but the price is still up 18% over the last month. So granted, the crypto space broadly is up like 60 something percent year to date. Uh, we've talked about how kind of a lot of the high risk, high beta stuff has gone up a lot year to date. So I don't know. I mean, memes do clearly move markets, but at the end of the day, does a meme generate intrinsic value? Does it, create cash flows? No, it doesn't. And unless the business itself creates more value, then it's just noise, which isn't maybe what memesters want to hear. I don't know. I saw Monative came up. I don't know if you had any speculations that you wanted to share on the Cohen
Lord,
tweet.
no, I've never understood meme craze and certainly not touched it because I get that I get that even less than I understand the companies themselves. So I stay the heck out of it.
Very fair. Okay. Well, anyway, we can, if people want to come up and chime in on the Cohen tweet and share their thoughts at any point, they're welcome. I did want to spend a couple minutes because Kyle is up with us, and I had wanted him to join a couple weeks back, and it just didn't work. But Kyle's been it. Well, I guess I'll do like a little short, brief intro. Kyle has done a lot of really good crowdsourced research on a company that's discussed in the GME Discord. It's kind of become a channel in the Discord that it seems like people all across the internet who are interested in this company flock to share crowdsourced research, which is great because I think that's really the objective of all the work that we've done in everything that was and became GME. So, Kyle, I know that for this company in particular, you did a lot of digging in a foreign language. You came up with some great insights that beat the company to the punch. And maybe though the market hasn't caught up with it yet, I just love it if you could spend a few minutes talking about your research, how that process was like for American Manganese, for Cyclico battery materials, whatever we want to call the company nowadays. But maybe just share a little bit about your background as an investor. How we came to know one another through the whole GME saga, and about your crowdsourced research process with Amy.
Yeah, that'd be great, Rod. Yeah, so thanks for the introduction. That was a pretty good overview. So for those who don't know me, my name is Kyle. You'll find me in the GME Discord under the name of I Lost the Game or I Lost the GME. Honestly, it started off as kind of a joke, but then GameStop took off, and things really changed. But I got into the GME Discord after the January 2021 kind of mania craze with the meme and all that good stuff, and have since moved on to some other stocks. But like Rod said, there's a sub channel in there for Amy American Manganese, which is now Recyclico. So really caught my eye because the market to me is really interesting. It relates to the changing industry for electric batteries and the recycling process and all. And I really just enjoyed learning about not just so much about the company, but about the technology. So if you'd like, Rod, I can kind of get into it. Do you want me to give more?
Yeah, before you get into it, I was going to say, for me, the same thing. It's been great to learn about the industry. This industry being all of the stuff that goes into the battery packs that underpin our electric vehicles. The reality is that I don't want to go too technical. I'll let you take it where you will. But the cathode part of the battery is the highest single cost component. And what American Manganese has been working on for many years is a closed loop recycling process by which the precursor cathode materials are of the same, if not better, quality than the raw cathode materials. So they're still a pre-revenue company. This is a very speculative stock, but there's been some great work done by you and others in the server to kind of surface where they are in the process, what's going on with some discussions with Korean companies. I mean, we've on this broadcast talked about the impact of the Inflation Reduction Act and how much money the United States government is just shoveling into electrification. Earlier this week, of course, the EPA came out with some proposed rulemaking that would further accelerate, if those rules are finalized, the adoption of electric vehicles by U.S. consumers. So at the end of those batteries' lives, they have to be, well, they don't have to be, but they should be recycled because it costs a lot of energy and money to dig the lithium ion, the lithium, the manganese, all the other, cobalt. We've all obviously heard, I'm sure, the stories of, the child labor in the Congo, et cetera. So like, there's a lot of costs and considerations all throughout the battery supply chain. But Amy has kind of a novel process, and you were able to dig up, I think, some really interesting due diligence that I think it was ahead of anybody else in the market. So maybe use that as a springboard, Kyle.
Yeah, thanks, Rod. That's a great place to start. So I'll just reemphasize what you said, how Amy is a pre-revenue company. So if you do like the things we're talking about, just keep that in mind. The company's Recyclico is still trying to break out into the market, so they're pre-revenue, that they're not turning a profit yet. So don't go running and dumping your money in quite yet, but certainly follow along with what's happening. So I'll back up to January 9th, which is probably the most exciting step in the process to date. So Recyclico announced an MOU they signed with a Korean company named Sonid. Now, at the time, I really didn't know anything about Sonid. They just were listed as an electronics manufacturer. They have since rebranded into a waste battery recycler. And the MOU talks about how they want to form a joint venture with Recycleco and bring that technology into the Korean market. Now, mind you, the Korean market makes up over 30% of the global market share for batteries. So bringing this technology to Korea, I think, is a smart move. Like Rod was kind of mentioning, there's the cathode part of the battery is really the high value part of the recycling process. So having the technology to return that high value materials back into the supply chain situated in Korea where the global market share is situated, I think is a great idea. So yeah, like Rod said, in the GME DD group, we kind of share a lot of news, and I came across some Korean news articles talking about the potential joint venture with Sonit and Recycleco. So since then, there has not been official filing from Recycleco about a joint venture, but what we did find is some discussions from Korean news reporters that are following Sonit and talking about what the company's up to. So one of the cool things we discovered was so on the English side of the internet. So what Recycleco has been talking about, no official filings, but the CEO talked about how they're going to visit Korea. Didn't really say much else besides that. But if you follow the Korean news, you translate some of the articles, you find discussions about how Sonit's excited to see Recycleco visit them. They're going to talk about joint venture demonstration plant and building an actual recycling plant. So since then, Sonit has actually released material news and the Korean filings related to like that end. So while Recycleco hasn't published an official joint ventureship, filing, Sonit has actually made several acquisitions talking about waste recycling batteries. So, for example, you have an acquisition of KSCB Chemical Company, and they specifically said they want to use that for the post-processing plant to use Recycleco in that plant. So that's kind of like the pieces are starting to fall into place. They've also acquired a lead acid battery recycling company. So Sonit now has the pre-processing and the post-processing parts of the recycling process. So for those who may not be as knowledgeable, pre-processing is more the black mass. So taking a battery and shredding it down into black mass, that's the industry term. And then the post-processing step would be the actual recycling process that Recycleco does. So Sonit has actually gone out and made filings. You can look this up if you follow the Korean side of the market. So they're actually progressing in towards the joint ventureship. So it's exciting to see. They also talked about how they're going to raise capital for the recycling plant. And if you follow the filings again, you can see several bond conversions. And Rod probably would know more about this than I do, but you can see that Sonit's raising money, raising capital to put into this new battery recycling business, and they've made a few acquisitions to secure facilities and permits and all that for the technology. So the only piece we're waiting for right now is to see Recycleco actually announce an official joint ventureship deal. But I'll pause there briefly for questions, and I can talk a little bit about the market opportunity as well.
Yeah, I was trying to pull up. Okay. So I have on my screen a couple different graphics that I just pinged you one of them, Joe. So one of them is just kind of the breakdown of a battery cell's cost. And as you can see, if you're following along, otherwise I'll tell you, this is from Bloomberg New Energy Finance, BNEF, that at the cell level, the cathode accounts for the majority of the cost on average, so a little over 50%. The manufacturing and depreciation is a little under a quarter, and then you have stuff like the anode, the separator, the electrolyte, the battery housings that make up the balance, the remaining quarter of the cost. So that cathode, which is depending on the chemistry, it's going to vary by which critical metals or minerals are going in. But it's expensive, and demand is going through the roof, and supply is having to ramp meaningfully to catch up. So recycling is obviously, if it's a low-cost thing, then it makes a lot of sense. You can take cost out. If you're an operator, right, that's what you're looking to do from a facility perspective. And one of the things that is a reality of how this stuff works is when you open one of these gigafactories, these battery production facilities, there's a lot of scrap that's produced in the process, especially early on when it's kind of going through the first year or two of getting things up to speed and smoothing out the problems. There's a meaningful amount of scrap material. So instead of just disposing of that, having to pay transportation costs to offload that somewhere and whatever you're doing with it, dispose of it, send it out to an external recycler. The idea for American Manganese that Kyle was kind of getting at is that they can co-locate that recycling facility, handle the scrap as opposed to end-of-life batteries, which, yes, eventually there will be a lot of end-of-life batteries, but for the time being, battery scrap from the manufacturing process really through the end of the decade, even beyond that, I've seen from estimates from Circular Energy Storage and others, is that the scraps from manufacturing will outweigh the end of life recycling pool for like a decade to come. So that's where the opportunity is for this process that American Manganese has patented. That it seems from Kyle's due diligence that there may be a deal in the works. So there is a deal in the works. It's just what does it shake out at? Do they get the final contract signed? But I mean, it was Kyle. Let me ask you, like, you've obviously learned a lot about crowdsourcing research over the last couple of years, as part of this kind of community. Like, maybe just talk about like what you've learned in that, and how you've effectuated like digging up these insights that other people aren't getting to in some cases.
Yeah, I mean, I really am a believer of the crowdsourcing, the model that the community kind of came up with. It's really launched me to be somewhat of a successful investor myself. So, the market, I know we see the market as being, like all knowing, but there are areas where I think, especially in newer areas that are still developing, where the focused retail group can find some edges and competitive advantages. And I think the term you use, Rod, is getting your alpha, finding alpha in the market. But sharing knowledge and finding areas where you can have a potential outsized gain with an investment, I think is possible if you take some time to do it with a group. So there's things that I might come up with, or someone else in the group comes up with, and somebody else has knowledge about it, and we can kind of cross-reference some of those things. Some of the members of the group have followed American Manganese for years, so when I bring up things about like Samsung's developing a new type of battery, well, somebody in the group remembers years ago when Samsung actually reached out to American Manganese. And those are things I don't necessarily know that they know. So now I can start putting some pieces together and then start lining up, potential opportunities in the future. But Rod, you really hit it nail on the head there. A lot of cool opportunities coming out. I do think Amy is getting ahead of the market. So if you look at the latest filings, what they're talking about, if you look closely at the words and what they're talking about with the cathodes in particular, almost every single release has talked about either NMC 811 or NMC 9. So for those who don't understand that, it's referring to the cathode chemistry type, and the takeaway from that is it's high nickel. That's the kind of the phrase to keep in mind. Is so all of their test results are based off of high nickel cathodes, which is the latest and greatest in the battery industry. And if you look at the big companies like Samsung, LG, even Tesla, they're all developing high nickel batteries for their electric vehicles. That's what's going to push the cost down for the batteries and the performance up. So to me, seeing that American Manganese, now Recyclico, is working on those high nickel cathodes, and they're working with Korean companies, is giving me indication they could be, this is speculative, could be working with one of those big players like a Samsung or an LG, since those companies are trying
there's
to
some
break
multi-billion-dollar battery manufacturing facilities going up in that part of South Korea, which was formerly like a steel manufacturing, right?
Yes, correct. Yeah. So again, I just want to preface this speculation, so can't confirm this, but if you look at the area that Sonnen is looking to build this recycling plant with Recyclico, it's about an hour, 2 hours from the big players like POSCO and Samsung and some other players who are investing billions of dollars, not billions of Korean won, but billions of US dollars to build like high nickel cathode plants and build that supply chain. So having Recyclo and even at the table in this market, to me, is like really exciting. The company is so cheap. I think they closed at like a $93 million market cap, and their burn rate's pretty low. So it won't take much to turn a profit for this company if they can actually license their technology and prove it out. But it's a new concept, so the market still has to catch on.
Monative, got a question?
Yeah, few ones, but I'll stick with what's relevant right now. So JB Straubel, right, the guy that
Ascend,
started
right?
Yeah, what's it? Redwood Materials.
Oh, he's Redwood. Yep, you're right. My fault.
Yeah, so he's just joined Tesla's board. So obviously there has to be some give and take there, right? So I'm assuming that he's going to grab, some, if not all, business with Tesla, right? Tesla is pretty big. I'm sure there's plenty of business for all recyclers because none of them are huge, really. So I was just wondering, how does this impact the industry as a whole?
Was that for me? Sorry.
Yeah.
Oh yeah. Yeah. So I mean, certainly, I'm very interested in a lot of those companies like Redwood. Um, to me, like when I look at some of these recyclers coming online, a lot of them are talking about for the time being, they're really situated on the black mass. Like they're shredding batteries down into like a black mass of material, and that still has to go through another step of refining. And most of these companies are the recyclers that you're going to see news about. They're just pulling out the metals, like maybe just nickel salts or cobalt salts or some lithium. But to me, like the reason I think Amy will have an edge is they're going a step further, so they're pulling themselves closer to the actual big players, like, to the actual cathode or battery companies. So they're recycling into a precursor, which is like the next step, so to speak, where all those metals are already in the proper ratios. So you'll see like Redwood talks about recycling. I think they're big in copper right now. I'm not up to date on the latest with them, but those Tesla's maybe unique because they're trying to do everything in house. But these other big car manufacturers, they all rely on battery manufacturers. So like everybody else who produces an electric vehicle, they're buying the battery cells from a company, and that company is sourcing cathode from a cathode
And Tesla's
manufacturer. And
sourcing
those
them from
companies,
Panasonic, at least in
correct? Yeah, yep.
Nevada.
So, and then to go a step further, all these companies are sourcing their precursors from China. So, like the latest stat I'm trying to pull a stat for 2023, but the latest I could find is it said Korean battery manufacturers are overwhelmingly sourcing their precursor from China, some 80 to 90%, depending on what you look at. So there's still this reliance on getting the materials into their supply chains and coming through China, and also they might have a relationship with the recycler, but if they don't integrate their full supply chain, they're still going to be reliant on the price volatility from trying to source materials from around the world. So to me, Amy is a great use case because they can secure their supply chain more locally. So instead of sending your recycled lithium and nickel manganese to another company, you can keep it more in house. So that's to me the biggest use case for Recyclico.
But to your
I
point,
think
Monative, Redwood's been making a lot of big investments. They are obviously much farther toward commercialization. I think they raised 700 million in a Series C last year. They've got a bunch of different multi-billion-dollar deals. And they're definitely an impressive beast. And Strobel is the former CTO at Tesla, and he was a co-founder. So he's definitely not one to be discounted.
Yeah, I do want to add. I mean, that's a great point. Tesla is like the big fish everybody talks about, but I think we also often lose sight on. There's a lot of smaller battery companies out there, and they're not all just electric vehicles. And I mean, I really even haven't fully understood the full market. There's a lot of you'll see ESS, electric storage solution types of batteries out there, which go into like golf carts and scooters and motorcycles and all that. So there's a whole plethora of batteries out there to recycle. So if you don't sign a deal with a big Tesla, there's still other opportunities out there, both smaller and medium sized companies.
no, I get that. I think where Tesla is really going, the amount of gigafactories they're putting up, I think the energy business is going to become larger, or at least that's the bullish take, is the energy becomes quickly a larger part of Tesla as a whole than the auto business, which, as much as the battery is the major part, it's still got a lot of other things, whereas in the energy business, that's pretty much, I mean, it's a bigger percentage of it, of the entire product, right? So I'm thinking if especially like you said, if there's a lot of wastage before the production comes into its own and becomes efficient,
Yeah, it's like 5 to 10
then
percent
I'm
scrap.
guessing,
It's meaningful.
yeah, then I'm guessing these guys are going to, generate, tens of thousands of tons every year, or a lot more. I
So
don't
the
even
the estimate
understand.
from Circular Energy Storage, who's done a lot of research on this for many years, and I've had the pleasure of meeting the head of, they marked it down last year meaningfully from 21, just the size of the scrap pool. But by 2030, their estimate is 900,000 tons globally of just production scrap.
Yeah, so that's a serious business. So I think somebody is going to be get really big here, or there's going to be a lot of M&A and rolling up all the small players with the right technology that can be commercialized.
Yeah, I mean, there certainly is a huge opportunity out there. I do want to add to the conversation, because this is such a new industry. I know, like, we're talking about it, but businesses and countries, governments move at a much slower pace. I think across the board, you're seeing with the various different acts being passed, like the Inflation Reduction Act. I think countries are still trying to figure out how they want to handle, not just the EV situation, but also recycling. Like in Korea, for example, who has a very mature battery market, they haven't issued, they no longer issue like recycling permits, because I think they're trying to establish a new framework for how the country will do recycling. So, that's one of the reasons why you saw Sonid acquiring previous recycling companies, because that's the only way to get a new permit. I think that's kind of, and my impression is that's how it is across the world. Countries are trying to figure out how do we handle these materials, because in some cases the lithium-ion batteries could be hazardous depending on how it's classified with the local laws. And I think, like, yeah. So to add to that point, somebody big could come along and figure it out, or maybe we'll see a plethora of
It's also
companies kind of.
interesting that there's a lot of, so from the same source, CES, they basically, the graphic I have on my screen, if you're following along, is a huge delta between recycling capacity and battery scrap. So like there's obviously a lot being built out, whether it's, there's a lot of different names of companies throughout the process. So not to go through them all, but there's going to be, for some period of time, for much of this decade, an excess supply of capacity to recycle before all of these kind of end of life batteries come into the fray. So that's where a lot of them are trying to lock down feedstock from. They're trying to lock in with an automotive OEM or a cell manufacturer, whoever, that they can get guaranteed sourcing of the scrap. So that's where it's definitely going to be muddy and noisy, and it's hard to know who's going to be the winner at this point. And obviously that's part of the risk reward, right?
Yeah, I mean, that's really exciting around like the opportunity out there with that scrap. So you'll see like big recyclers or the companies that are coming online. They talk about recycling, but they don't always mention how they're bidding for the scrap material. So right now, the big companies like the battery manufacturers are just selling their scrap because they don't know how to handle it. But there's going to come a point where those companies may say, well, do I sell the scrap to somebody else, or do I keep it and try and process it myself? And the market's trying to figure that out still. It's a newer concept, a newer technology. But yeah, so you might see companies bidding for material, trying to lock down feed source or feedstock agreements, and it might get pretty muddy there. And I think it's going to be really exciting just as a person to see, and hopefully as an investor, it'll be lucrative if you back the right horse or the right companies.
Okay, I have two other questions. So one, is there support from the Inflation Reduction Act for this industry, for the recyclers? And two, do these guys get carbon credits? Is there some tradable carbon credit to be earned here? Is that a revenue stream that's even significant enough to write about?
So I have a limited knowledge on the Inflation Reduction Act, so maybe I'll default to Rod. But I do know, depending on where the material's made and recycled from. So like Korea, for example, since that's what we're talking about, Korea has a free trade agreement with the U.S. So I think companies using materials from Korea could qualify for the Inflation Reduction Act credits. But I don't know for sure across the board. Maybe Rod can jump in
Yeah,
here.
like it's not a specific. I guess, like as far as I know, there's not a specific. Like it goes back to the eligibility for any and all of these battery incentives, which is that they need to have certain percent of the components extracted or processed either in the U.S. or in a free trade partner nation, which goes back to the Korea conversation. The South Koreans have been leaders with LG Energy, Samsung SDI, like SK Innovation. That the Chinese obviously have a huge share and have grown meaningfully in recent years, but I would say the East Asian players are the ones who run this market broadly. There's of course some startups in Scandinavia and then Europe and in the U.S. as well. We've talked about a bit of, but the IRA piece is more about just the location of this stuff and the broader incentives. I don't think there's like a set one. Like it's not a direct, I guess, incentive, but it if that makes sense.
I will also dig more, but I'm just trying to quickly scan through some stuff. There is credit for using recycled material, which leads me to believe that some of that will default to the recyclers themselves. So I'll dig up. I'll come back next week with an update on this.
Yeah, and you would, I would bet that there's legal teams and business teams at these big companies, like Rod said, like your LG, Samsung, and SK, and they're closely looking at the Inflation Reduction Act, the CRMA, I think, is in Europe and these other countries, and they're doing the math to figure out, is it better to do a feedstock agreement with the company, do we in-house technology, or do we sit on the material? And I'm sure they'll do the math internally to figure out how can they best leverage these different acts that are passing around the world, because they're in the driver's seat. They have the material.
The top 10 EV battery manufacturers are all headquartered in Asia, concentrated in China, Japan, and South Korea. So, sadly, there's not one American company in that top list. I guess you could. Tesla folks would try to argue, even though it's Panasonic, the relationship. So whatever. But look, Kyle, thank you very much for sharing kind of some of your findings. I mean, to me, the most important thing is like just the fact that you and some of the other guys who've just been digging into this are dredging up things before even the company, puts out a press release covering it. And, it's Korean language. So I know you're not a native Korean speaker. So you're working your best with, whether it's just straight up Google translation, but just like it highlights to me the reality that you can uncover information that the market at large is not yet pricing in and has not yet identified, which isn't to say that it won't take the market a long time to catch up with that information, but I think informational alpha is absolutely real, and I felt like this was a good example of it. And Kyle, I continue to enjoy following your research on American Manganese on the channel, both you and Scott and all the other guys who've been at this for a long time. So yeah, it'll be interesting. Hopefully they do, in fact, sign a contract with one of the big Korean players that they've been in discussions with, and whether it's Amy or a smattering of other players, like there is some nuance in like which exact level, like piece of the process they slot in with. So yeah, it's a very interesting. It's absolutely a growth industry. It's going to be interesting to monitor for sure over the next decades to come, as we are apparently, according to the government, going to all be using electric vehicles eventually.
Yeah, thanks, Rod. I think I'll just finish by saying like the exciting moment for me doing research was when we found discussions from the Korean side of the market, the Korean news, saying how the Recycleco CEO and management team was coming to visit Sonid to work with them in Korea, and then like a day or two after, Recycleco said, "Hey, we're taking a trip to Korea." So I was like, "Okay, we caught that ahead of time." And then we see a picture with the CEOs shaking hands. Like to me, it was pretty cool to catch that beforehand and see that unfold. So it definitely been exciting, and I appreciate you having me on to talk with everybody. Thanks.
Yeah, thank you, Kyle, for joining and sharing. Okay, so just kind of where are we? We've gone through most of the prepared material. I'm going to spend a minute maybe talking about just some of the different macroeconomic data that I'd kind of seen this week and how I think it shakes out. And then it's 5 to 5 here Eastern, so we start at 4. If anybody wants to come up and either ask any questions on any of the topics we've covered already or related, we can go from there. So macro, we got a lot of different data out this week, especially inflation-related data. We got bank earnings this morning, so the start of bank earnings this morning. The good news is on the inflation front, the data, I think, came in broadly in line with what you would have hoped to see if you were the Federal Reserve, in that we had it come in lightish relative to what was estimated. The absolute level of inflation is, of course, still higher than the Fed is comfortable with, and the speakers will continue to note that. But it does feel like, and I think we've been talking about this for a couple of weeks now, really since the banking, I don't want to say the word crisis because that's not the right word. I've heard Mohammed El-Arian use the word banking tremors. Maybe that's a better word. The banking, whatever you want to call it. Really since then, the shift of focus seems to be away from inflation and toward recessionary risk. So while we've seen, yes, good inflation readings coming in, producer prices showed a big 0.5% decline month over month when that data came out earlier this week. The Fed meeting minutes, obviously the market reacted a little negatively after those came out on Wednesday at 2 o'clock, whenever it was, with the language about staff economists projecting a mild recession. It gets back to the reality that a mild recession is simply a part of an economic cycle. Economies don't go straight up. A recession also does not mean that you have many millions of people out of work and that the economy is grinding to a halt. A recession, can be a decline in the rate of growth. So like you see stuff that's implying that that's probably going to happen, a slowing in growth, whether it stays positive, whether it goes negative for 2 quarters. It still remains to be seen. None of us know exactly, but credit conditions from survey respondents in small business, those conditions tightened meaningfully over the last month on the back of the bank issues. And the market, I didn't look within the last hour, so let me see where it's at. It's still pricing, it's up to a 78% chance is priced in as of today that there would be one 25 basis point hike at the next meeting, and that would effectively be the last hike. I personally still don't think they hike, even though the market is saying they do. And maybe they will. I tend to think it's a mistake to continue tightening when kind of you see that things have rolled over from a lot of the inputs that will eventually become outputs of consumer price index. The consumer price index is not a leading indicator; it's a lagged indicator. So we'll see. There's been several Fed members. There's the newest member, Austin Goolsbee. His line earlier this week was that they should have prudence and patience, and that's the appropriate path forward. The fact of the matter is that this, as Powell said at the last meeting, they don't know exactly how much tightening there will be as a result of credit conditions tightening. So if credit conditions do meaningfully tighten, as the data seem to show from at least the survey respondents that are small business borrowers, that kind of helps the Fed, right? Like the Fed doesn't have to keep raising rates as high as they would have otherwise if credit conditions themselves are tightening separate from that. So I guess my sentiment is that you got good data this week if you are in the Fed doesn't need to overdo it camp. The market is still pricing in significant rate cuts in the back half of the year, which that seems to be the area of some disconnect to me, that if you're going to be cutting rates in the back half of the year, that's probably not happening for good reasons. It's probably because demand has really fallen off a cliff and that the economy is not doing well. So, if that were to happen, I tend to think equities are mispriced for that. But we'll see. Okay, I don't want to go through all the stories too much in detail. I'm sure most everybody's read them and caught up with them over the week. But the bank earnings this morning were obviously great from J.P. Morgan stock perspective. What did it close up? Closed up 7.5%, which is just massive for them. I think it's one of the biggest moves since the GFC. The other big banks kind of all fell in line, being up. The even the regional bank index, based on some of what Jamie Dimon had to say, closed down. Well, surprisingly, although Dimon's language is kind of along the lines of, he thinks regional banks are going to come out of this maybe better than people had thought. Um, but yeah, that's all I had then from a prepared remark standpoint. If anybody wants to chime in on the economic data front or on the Cohen tweet, if you want to share what your speculative idea is on which great American brand he's about to tussle with, or on the Baba and Chinese AI, any and all are fair game. Would be happy to hear from some folks who are in the audience. If, don't be shy. You can come up, and there's no right or wrong answer to this stuff. We're just trying to all figure it out together. So I don't know, Monadiv, I'll put you on the spot while seeing if anybody else is going to come up. What is your take from kind of the bank earnings and this week's economic data?
Well, worst case scenario, these are the best bank earnings you'll see, and it's downhill from here. Best case scenario, it's not as bad as it could have been. So across the board, things might not be horrible, and we've seen most of the bank problems are behind us. So answer is, I guess, somewhere in between. But those are my two polar thoughts on either side of the spectrum. So I honestly think a lot of even super regionals will be fine, but there will be more mea culpas from smaller banks that are more specialized, right? Especially ones that are high net worth banks are not going to have a viable business model until they do something else, until they change something. JP Morgan can get away with not really paying much interest on their deposits, but most other banks are not in that position. So net interest margin compression is probably very real, at least until the Fed cuts enough. And then loan loss provisioning is probably going to have to increase all of this year, minimally. Those are my two takes that I'm looking for. So not so much results, but guidance, right? Remember, this sort of came, 10, 11, 10 weeks into the quarter, so it wouldn't have impacted the quarter as much as this current quarter. We have to see what it is. So basically, net interest margin compression, loan loss provisions, and guidance. Those are the three things I'll look for in financials.
And we've still got to get right, because the last jobs report that came out last week was on a survey that was taken, I think, like right when the bank issues were perking up. So from what's like really happening in the economy, we've obviously got to get more data. You're right. The first quarter results didn't really show much of the effects. Obviously, the deposit flows that the big banks have taken in, especially J.P. Morgan, helped boost their interest income. And you're right. I mean, if I'm J.P. Morgan, I don't need to raise rates meaningfully. And every dollar that comes in, every deposit dollar that comes in, I can just park in the reverse repo window for 4.8%. I'm going to pay a couple of basis points into in my JP Morgan savings. Does that keep creeping up? Probably, but I don't think that the systemically important banks are likely going to raise their rates meaningfully anytime soon, and it doesn't seem like consumers are going to flock elsewhere. I mean, there's been people flocking into money market funds, right? There's been a lot of reporting on how much capital is going into money market funds, and short-dated treasuries are really seeing a lot of bidding activity. So I'll be interested to see what happens with this whole debt ceiling debate. I think that's a bigger concern to me at this point than the banking systems issues, frankly.
Yeah, I mean, the only real risk I can see for any of the GSIBs is probably counterparty risk from one of the weaker ones, right? So that still could be something that really hurts earnings, but not so much this. I don't think this deposit flight is going to even cause a hiccup. In fact, I think it's helped all of them. So I don't see this as a problem, but yeah, counterparty risks, probably there's going to be some amount of write down from there if somebody big enough goes under anywhere in the world, right? Also, 3.5 unemployment rate, so we went from 3.6 to 3.7 or 3.5 to 3.7, then back to 3.6 now. I think that's an outlier. I think it's going to be revised up. I don't think that was good data. I think its preliminary data is probably very weak. So I expect unemployment rate to start creeping up, and it should not. I think that down cycle there was completely unexpected. So I expect that to get revised up.
Yeah, and the jobless claim numbers are definitely starting to tick up. And I know there's been a lot of kind of issues with how accurate has some of these survey data been and the revisions, but I'm with you there. I think we've probably seen the lows in unemployment rate. We're going to see an increase in it, and the question is, can it rise in a slow, controlled manner that would, meet that hope of a quote unquote soft landing, as opposed to something that goes nonlinear and we start to get, you know, big ramps and layoffs and et cetera. So again, none of us know what's
In
going to
that
happen yet, but
sense, yeah, in that sense, right? I think it's a good thing that we're not seeing every sector break down quickly, right? So tech has been laying off for close to a year now. So by the time the other sectors start falling one by one, I think tech would have stopped the layoffs or hit the bottom there, and at least they'll be flat and not getting any worse, within a few quarters. I think certainly on the layoff side. So in that sense, I'm a bit encouraged that they are far more aggressive than I expected them to be. So this is a good thing. I do expect them to lay off a lot more. I think we're not done, but it's a good thing that they are front ending that and taking the pain quickly. Especially somebody like Meta, I think is for all the fuck up they've done the last 10 years. I think they had to recognize that this was their opportunity to start cleaning up, and they did that. So I give them credit for that.
yeah, what I'm most interested to watch over the, I guess, kind of summer, as summer arrives, is as consumers maybe start to run out of gas on excess savings and maybe their student loan payments get flipped back on. What has been a really strong hospitality, leisure, travel space in terms of net job ads, like how much more does that have in the tank? To your point, yeah, tech's of course gone through its layoff cycle already. Well, we haven't really gone through the layoff cycle for maybe some of the more services side of the economy. Construction is like just starting, I think, to roll. Transportation, um, it's like if you've got, and this is what I keep saying, is you're probably going to have like not the economy at large all nosedive at once, but it's like one sector is going up, the other sectors are going down. So some sectors in recession, some sectors in expansion, and you just get kind of a noisy message overall. But it's okay if GDP growth comes in low and if unemployment ticks up slightly. That would actually be a good outcome, right? That's kind of what the Fed wants to see, is those things happen, inflation returning by the back half of the year, closer to its 2% target, not getting there this year. But not that anyone wants to see somebody lose a job, right? But that's just kind of the way that the business cycle works. Okay. Anyone else want to chime in on economic data, on battery recycling, on any of the other topics that we've gone through or other? Last one alive. I've got you coming up. You want to chime in?
Yeah, my question is, with all that excess liquidity, like parked at money market funds, savings that people have, don't you think that on the Fed, kind of like, even if inflation comes down, like leniently, don't you think like once the Fed starts easing, don't you, don't you think that's going to spark inflation again, or no?
I mean, look, that we. I mean, I'll like say broadly that there's been since COVID began, and supply chains have shifted away from lowest cost, which was generally a China-oriented sourcing strategy, to a China plus one or a more resilient sourcing strategy. Like, there are some structural changes in global supply chains that are, by their nature, inflationary. I also think that a huge chunk of the inflation that we saw was actually transitory. It was a byproduct of misalignment between huge amount of demand, stimulative demand, through all the
Yeah,
dollars thrown in.
that's
Yeah.
yeah, that's my question though.
So like I
Like, right?
do see there's structural reasons why inflation going forward over the next 10 years would be higher than the preceding 20 years, but that the magnitude of that, I don't think we're going to see inflation readings in the high single digits again. Um, if the Fed is easing monetary policy at some point late this year or early next year, personally.
The reason why I asked that is because I don't see businesses spending to increase production. Like, they're actually contracting, they're actually limiting, they're actually like cutting down costs and expenses. And with all that the excess liquidity, to me that equates like that equates to like high demand still is still out there. And I think that if the economy starts picking up again, I think you're going to have the same dynamics you had. We'll call it inflation in the first place, where you have demand supported by excess liquidity outstripping supply, and businesses are going to have to catch up.
I mean, we talked about the ISM report last week. I mean, the purchasing managers, at least on the manufacturing side of the economy, continue to see sales, slowing. Right, it's been in contraction now for, what is it, 6 months, 7 months? The diffusion index. So, like, the individual data sets, though, like the new orders index came in really weak again for March ISM PMI. The prices paid also again came in below that kind of 50 mark. That prices are actually declining a little rather than expanding. So, like, I mean, I can see your point, and I think a risk to the upside for inflation would be which I do not think that there would be, but if the congressional parties had some kumbaya and decided to stimulate the economy further, which doesn't seem likely, but if there were a slowdown in the back half, I don't see why they would do some incremental fiscal spend. But no, I think there's some structural changes that are inflationary, but that maybe that means that instead of the economy lingering at a really low level, maybe it's a little bit higher than that. But nothing like some of the hyperbolic, crypto people like Jack Dorsey saying hyperinflation is here. Obviously, he was dead wrong, just like he was dead wrong about Elon Musk being the only person who could save Twitter, right? So people like to be hyperbolic, and it just, that's just not. This doesn't cut it for me. I don't think that there's anything to be hyperbolic about with inflation right now. I think it's actually trending in the right direction. It's not where people want it to be. There's risks that are out there, but I actually think that, look, it's an unpopular opinion, but I share the opinion of Mr. Buffett, of Mr. Marks, that Mr. Powell has done a fantastic job and continues to do an excellent job. And it's a tough job, and he is doing the best job he can. And, we'll see what they do in May, and whether they do one more hike and then they hold for a little while, who knows? None of us know. I think everyone's trying to do the best they can with the information that's available. And the reality is that it's a very fluid situation. A month ago, we had a bank crisis, and we didn't know what was going to happen. There was very, very quick action taken by the Fed, the Treasury Secretary, and the FDIC to ensure that it didn't potentially envelop the economy and become, a flash recession or whatever it could have blown into. And thankfully, it looks like it's mostly in the rear view. There's concerns and risks, and probably there will be more bank failures, right? But that doesn't mean that depositors need to fear for their deposits, as Buffett would say.
Oh, another question. Well, when the Treasury, when the debt ceiling issue gets resolved, the Treasury starts issuing bonds again. How do you think that's going to affect the yields on the bonds if they're issuing? They just come out and issue like a large supply of bonds onto the market. Is that going to cause the yields to go up, or is there efficient demand out there to consume all those bonds that are coming onto the market?
I don't have any insight there.
Getting back to your remarks on inflation, like the Federal Reserve's target is 2%. Do you think the last 1 or 2% is going to be a lot more of a challenge, a lot more resilient than it has been so far with the decline?
I mean, it's at the end of the day, it's a math equation, and whatever inputs go into it. I'm not an inflation, I don't have some wild inflation model of my own, so I just broadly would say that if we can clearly see that both expectations are coming in line, are at normal levels, that producer prices are kind of coming down. It gets back to this idea of, are businesses going to just, this is the $1 trillion question, are businesses going to allow their margins to compress from historically high levels if costs coming down and they are not passing that cost through to end customers? That's a boon for them from a margin perspective, but it is a competitive marketplace, and the presumption would be that your consumer can go elsewhere and find someone else who maybe is willing to take price down when their input costs go down. You're right that it's still above their target, and it's unacceptably high, and it's negatively impacting a lot of people, especially on the lower rungs of society, who don't have the excess income to absorb increased costs. But the direction is moving in the right direction, and it's like, what does the Fed gain by raising another, say, 50, 75, 100, whatever, and really crimping the economy and then sending it into maybe a worse recession? Maybe does it get them to their target faster? Probably a little bit, right? But is that the correct decision in the context of their dual mandate? I don't think so. So, I mean, it's tough. It's no easy answers.
Yeah, I'm just curious, what would be the impact if core inflation, sticky inflation ended up being 2.5%, 3% for the next several years. If the Fed would find that acceptable. I guess there was some talk, I think a couple of months ago, people were saying, oh, maybe they'll change their target, right? Maybe they'll, kind of get, cave in a little bit, but it doesn't seem like they're going to do that.
Yeah, and frankly, that has no bearing on how I think about individual equities from an investment perspective. Like if the Fed's target is explicitly changed from 2 to 2.5, which I don't think is going to happen, I do think we're going to pretty quickly here over the next few months be talking a lot less about inflation and a lot more about recession as the data kind of keep deteriorating in the labor market. Which again, it isn't to say that the inflation has returned to their target when that maybe shift in priority happens, but I do not see them explicitly changing the target imminently. I mean, they've all pushed back on that notion, all of the voting members I've heard, unless you've heard otherwise. So I don't see that being in the cards for the Fed to say, you know what, we're going to set the target at 3% now explicitly. Maybe it happens.
Don't you think that inflation is going to tick up next month just due to oil went from like 68 to 80?
Frankly, I don't pay that.
And it was a bit.
I couldn't tell you what the noise in the short-term data really means. I think that I'd rather look at like the trend, and I think the trend is in the right direction, even if there's some blips along the way. But you're right. Yeah, if oil, as a result of the OPEC cut, I guess I saw that the energy secretary made some more comments more recently that they would be refilling the SPR. Like, yeah, all else equal, if oil returns to 80, 90, 100, that's inflationary. That's not helpful for the Fed's goal. And does that mean that all else equal, if oil trades that way, maybe then they do have to stay higher incrementally for longer, or there's one incremental rate cut? Sure, maybe. But I don't know. I don't think that I would get too hyper obsessed. And I get it if people are like doing a lot of short term trading. That's important for them, but it's not really our focus.
What do you think? What do you think about the dollar and its impact to commodity prices? If the dollar goes underneath 100 and there's like 98, 97, don't you think commodities, especially with China like bouncing back, don't you think commodity prices are just going to skyrocket?
I don't know about that, but I do know that one of the greatest investors of all time is adding to his Sogo Shosha positions, and the Japanese trading companies do quite well as commodity prices go higher. So I know he likes those businesses, and he's obviously not betting on what happens in the next month or even the next year when he makes an investment. So there's something to be said from an attractiveness of commodity businesses when you see Mr. Buffett making those additional investments. There was an op-ed in the Wall Street Journal from Daniel Yergin this week, kind of highlighting how long the lead times are for these mining projects and the risks in a lot of, whether it's Peru, Chile, where there's a lot of political turmoil and uncertainty. And if you're a mining company trying to invest for all of this demand for lithium and manganese and cobalt, et cetera, that we've been talking about, when we talked about battery recycling earlier, that, I think that the age of, we had a really weak commodity market for a while there, right? And got negative oil in 2020. And I think people who maybe are hoping that commodities are going to just go back to the floor again, maybe that's a little bit misguided. But I don't know. Mr. Buffett clearly sees a lot of promise in the trading houses, and commodities are a big aspect of their businesses as a long-term investment opportunity.
Yeah, thank you. My point is, I think we're going into a stagflation environment, and a lot of people don't understand that. I think the economy is going to slow down, but as the dollar goes down, as it's going to drive commodity prices up, and I think that's going to cause inflation to stay a lot elevated than most people think.
Hey, Baron, Monsieur, did you want to chime in?
No, yeah, thanks a lot for letting me speak. So I've been listening to you guys. The one of the things like I've been looking since last few days, a lot of people have tweeted that the earning expectations they so like what the analysts are making out as the earning expectations.
Mm-hmm.
In Q3, I think there is a 7% decline in earnings. Sorry, not Q3, Q2 and this quarter. And then they rise like in Q3 and Q4 and in next year, Q1, Q2, it's like a hockey stick shape earning recovery. And they are like saying year to year, it would be in Q1 2024, it would be like 14%. So I think, I don't know what, I have hard time imagining like how can earnings like grow 14%? Like anybody has any idea? Because when I look at the like weightage of the tech in S&P, it's hard for me to believe that like earnings can grow by 14% next year. So, or at least in Q1 2024. And I think markets are basically trading because a lot of the market actions from last 1 month, it has been like, okay, we are not having a recession, maybe a mild one, but then the earnings recover in 2024. And in average for the 2024, it's like at least 9% of earning growth. So like from 230 we go to 260, something like that.
Yeah, I'm looking at what the current consensus out of Refinitiv and at Yardney's shop publishes. This was earlier this week, so it could have changed a little bit, but it has full year 23 at 220, which is up a little less than 1% from 22. And then you're right, there's a huge bump in 24 that's currently baked in, which would go all the way to 247 as of Monday's data, which I agree with you. It does seem overly optimistic, especially in the context of how historically high profit margins are and what looks, it's like, I don't believe it. I think the market is overly optimistic about earnings still, both for this year and next. I think we'll have to see as the next few weeks go by and we hear from other companies kind of what they're seeing. How much do analysts, well, maybe they don't, but I tend to think they need to mark down estimates in the back half of the year more. And whether maybe the companies also say they just don't have a lot of visibility, which of course a lot of them have been saying is, for 24, Diamond this morning said they don't have a lot of visibility to 24. And you might get companies out with Q1 results saying, we really still don't have a lot of visibility to 3 and 4Q of this year. But we just started earnings season. So as that data comes in, I do think we're going to get revisions downward is my belief. But let's see, right, what the data end up showing.
Yeah, I mean, look, it's still too far out for analysts to seriously, break down the numbers and dig into it, right? Analysts are also significantly guided by what the companies themselves project. So, and companies are really, you can only take a quarter ahead. Beyond that, the numbers are all just thrown out there for, just putting a model together, not with any significant level of confidence there. So I wouldn't personally. It'll adjust itself quarter after quarter. So I don't know how much value is there looking at earnings 3 quarters out. What would be an interesting exercise, Baron, is to see, how far they've adjusted, historically, if there's a graph that tracks 3 quarters out earnings or 4 quarters out earnings and see how it gets adjusted as it gets closer, or, expectation versus what happened, right, with that 3 quarter lag. That would be more interesting to me as a data point rather than looking at it in isolation. I think it's valueless, right? Clearly, earnings are coming down and will continue to come down. So I don't know how much value I would attribute to, I don't think current prices are really baking in, earnings jumping anytime soon. I think they're more baking in, a relief that worst case scenario is not coming true. That's all I think there is in the price today, right? All of the tech run has been that, hey, it could have been worse. It's not. Let's, it's so maybe things are not as bad as it is. So I think this gets revised every quarter down.
And those rate cuts priced have, I think, also helped tech as well, disproportionate to other sectors.
Yeah. On the long duration assets, things like Amazon. But yeah, it's really hard to believe. I can't see a way where like earnings grow like 9 to 10%. So I don't know. I think that is the reason why emerging like some of the markets which were cheap, like European markets and DAX. So DAX is up like more than 30% in last 6 months, and it's even positive for the whole year, not year to date, but for 1 year chart. But it was cheap, like last October it was like 10 times earnings. So there, and I think Europe, a lot of news has been coming out that the industrial production is going up, and I think the recession which was forecasted is not going to happen. So yeah, but the Americans are really overly priced if I compare them to like
and
rest of
especially
the
the
world.
big cap American companies, like relative to smaller cap, as I understand it, it's like the biggest premium since .com bubble, and that it's not to say that those aren't great businesses. Clearly they are, but what are the forward returns? When you're buying Apple, and I made a comment yesterday that like the 2027 PE is still north of 20, and that's with current estimates. And is Apple going to be around for a long time? Absolutely, but there is a price at which you're paying too much for future earnings, and I tend to think with a lot of the big tech companies, maybe it's the recency bias, right? These companies dominated for most of the last decade, and therefore we're used to ZERP. We think that ZERP maybe will come back, so we're going to go try to run the play that worked last time. I don't think it's going to work the same as last time. I'm personally very underweight. I have no exposure to mega cap tech in my personal account. But I'm also biased to investing in small caps because I don't think there's as much alpha there in mega cap as there is in small cap. But your point is valid that relative to emerging markets, U.S. large caps are pretty extraordinarily rich, and even relative to American small caps, big caps are pretty rich. Like the forward PE on the S&P 500 is north of 18, but then if you look at the 4 and the 600, it's 13. So I think there's a lot of value to be found actually looking outside of the S&P 500. But we'll see how it pans out. Year to date would have been a lot better suited just being overweight mega caps.
Hey, I just posted Lipper Analytics, a preview of the upcoming earnings quarter. So it's a very nice article, and I subscribe to their dashboards. They're very good at reporting it. Best to check it every Sunday because they update their the weekly earnings with data. So it's a wonderful dashboard. So take a look at that. But the point I was trying to make is, right, I mean, look, S&P 500 is still a massive aggregation of a lot of things, and there is maybe a headline there, but there is no intelligent data there, right? What are you gonna get from counting a forward P of 18.3, which is what Refinitiv is calling for S&P 500? To me, that has no value. I want to look at it at a much micro level,
Well, if
right?
you're buying the
At an
S&P index,
industry
then
level.
that's what you're buying. But I agree with you. If you're buying an individual
Yeah,
equity, that number isn't what you care about.
exactly, right? I mean, for zero DT index traders, that might have some meaning, or for people that are investing in the ETF, that might have some meaning. But I'm not. I'm looking at a part of this number. So I don't. For me, that headline matters very little. It's something like like you look at the traffic in the rearview mirror. I just keep an eye on it occasionally, right? Every few seconds I glance at it, or like every few weeks in this case. But I don't make my decisions based on S&P's PE. I'd rather look at the industry PE and compare it to where it was, or compare it to other industries, PE, and see whether it's overvalued or overvalued historically by its own comparisons. To me, this is too big a number to make a decision based on, unless you are purely getting some directional data on where the economy is going. Beyond that, to me, it has no value.
Yeah, but at the same time, Monitive, you would agree with me. I mean, S&P is the benchmark for, I mean, most of the industry, like all the mutual funds. And I think the way they structure their portfolio, most of the mutual funds, hedge fund, I don't know about hedge funds, but at least the mutual funds, the pension funds, the way they structure portfolio, they are always like in some beta to S&P. So I mean, if you look at a lot of managers' portfolio, the most, except for exceptional managers who like go about the things that are completely uncorrelated to, and they get alpha. I mean, but the people like those are very few and far. So I think it remains a benchmark for a lot of people, and they structure their portfolio in weightage to that. I don't know a big manager like
To compare your returns to the market, yeah, I get that, absolutely, right? Otherwise, there's no point investing yourself. Might as well just throw it into the S&P fund and be done, right? That's the whole point. Yeah, that makes total sense. If you want to, benchmark a very wide holding that mirrors the market, but for some reason you don't like the SPY, yeah, you can benchmark against this. But if you are really investing in energy, all you want to look, just as I'm just throwing out an example, all you want to know is, hey, am I investing in energy and doing better than the S&P, or am I doing worse? If I'm doing worse than S&P, then why am I investing in energy? So that would be a comparison to me that makes sense, rather than saying, I have to benchmark against S&P irrespective of what my portfolio is, right? So I think keeping an eye on it, which is why I said I have to keep an eye on it, because if I'm not beating that, then I'm wasting my time, right? I might as well just throw it into the index and be done. That would be the smartest, simplest thing to do if I'm unable to generate alpha some other way. But if I am, then all I want to know is how well am I doing relative to the effort it takes and the risk that is adjusted for that, right? The increased risk that it brings.
All right, guys, good discussion. Again, just a time check. So we're 20 to 6 here for us East Coasters. I think we'll probably wrap around 6, keep it at 2 hours. So we've been talking about, obviously, inflation, the macroeconomy, index returns, and what those returns may look like. We've talked about battery recycling, at AI, and what China's regulatory regime is going to look like, as well as what is the meaning of Mr. Cohen's tweet from this week and which company may be his next target. So if anyone in the audience wants to ask any questions or chime in with any thoughts on any of those topics, feel free. Or we can keep kind of hammering at whatever. Yeah, again, just want to say thanks for those of you who did come up and have come up and shared some thoughts. We appreciate it. We're hoping to make this as engaging as possible. I don't want to tip too much, but I think Joe and I are very excited. We have some major changes coming down the pike in very short order that I can't go into detail on just yet, but I'm very eager to see where we end up. I think we're going to have some much larger audiences once we do those things. But yeah, if anyone does want to speak, please just request. We will bring you up.
Yeah, I got a quick question. I was wondering, what is your outlook for the next 3 months regarding equities?
Well, that's a pretty short duration. If you put a gun to my head and asked me, do I think that U.S. indices trade higher versus lower come mid-July, I would definitely bet on lower than current levels.
I was just going to say earlier today, I saw somebody tweet that the corporate bond 2-10 yield curve had inverted. It was interesting.
I'm just looking at the 5-year chart of the major indexes. And again, if you're buying the index, that's one thing. And if you're benchmarking to the index, that's another thing. But the NASDAQ is still up almost 100% over 5 years. That's, maybe you wouldn't think it because it's off the highs, but it's been a pretty extraordinary rate of return at current levels just over that period of time. The absolute levels of valuation, as we talked about, strike me as pretty stretched. So going back to, is there a case to be made that it keeps going higher because there's a lot of cash that's either sidelined or professional investors may feel the need to chase if they are lagging the benchmark as the year keeps going by? I understand those arguments, but we by and large are not speculators. We're more interested in long-term investment theses, and I get that trading folks are more interested in what's going to happen tomorrow or next week or next month. As hopefully kind of a discussion around battery recycling, relays. We're much more interested in what's going to happen over the next decades to come. When trying to think with an investment duration in mind, which is hard to know, right? It's hard to know tomorrow, let alone a decade from now. But all else equal, I think smaller and mid cap offers more opportunity to find alpha right now than big cap from U.S. equities. And I think emerging markets, as Barron was kind of getting at, there's a lot of interesting stuff. Warren Buffett was talking about how Japan is his second highest allocation geographically, other than the United States. And I've seen a lot of great research written about there's so many Japanese equities trading as nets, trading at big discounts to tangible book value, and there's whether it happens or not, there's a push, I think, from the Japanese exchanges to remedy some of these deep discounts and have some more shareholder friendly actions. But again, it's like for American-based investors, it's hard to get that alpha or that deep insight and knowledge of a Japanese-based company if it's only operating in Japan and you have no, business in Japan. So it's tough, right, to invest outside of your backyard. I think, and that's where indexing could make sense. I think indexing to me makes sense if you want exposure to a sector, to a geography, and you maybe don't have the capacity to do some real work on individual companies and have confidence in your ability to allocate capital to individual names. So I could see the case to be made for indexing, in those scenarios for sure. But yeah, I'll stop rambling.
But when you're indexing, I mean, how many of these Japanese stocks are in these index funds, these ETFs?
I mean, it depends on the fund.
Yeah, but I guess besides like emerging market funds, I mean, I don't really see how, like, I mean, we were talking about this earlier about British American Tobacco and how like they don't get inclusion in a lot of ETFs as well, in indices.
Well, yeah, that's a really good point because I mean, what are you buying? You're buying future cash flows. So if you're getting a higher yield, all else equal, that's better. While maybe in a very short term, like wanting the price of the equity to go up, if you're just going to pull forward future returns if the price of the equity goes up a whole lot, right? If British American Tobacco relists in the U.S., like that's great. Yes, the price probably goes up. Your future returns will therefore be lower. You've of course then realized some of those returns, but it doesn't change the intrinsic value, right, of the business at all. I mean, I guess you could argue if they get a lower cost of debt and they're able to, take advantage of lower cost of debt or equity, that is advantageous to lower their WACC. But, I think you know what I'm getting at, Chris, and I think you agree.
Yeah.
Hey, quick question regarding Japanese stocks. But if the yen appreciates and central bank in Japan uh, 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 like steps down as quantitative easing, isn't that going to be like a headwind for equities? Because what's kind of been propping up the equity, quantitative easing and the yen depreciating, what made it relatively cheap for foreigners to buy.
I think it has been completely inverse. So I think they have been doing QE. I think since I don't know, but I think since 1992 they were the one who like started doing QE. But I don't think that doing their QE has any impact on their stock market. But that is the way I think. I don't know.
No, because every time the like I've been watching Japanese the indexes, and every time the market assume like like uh like they're going to reverse or recalibrate the quantitative easing, the equity market always like is sold off like 500 points, and the yen appreciated. So I think it does have an impact. I just don't know how much.
I can't say because they have a lot of companies, as like Wook was telling, like they have a lot of companies which are really, really cheap, and even among big caps. So I don't, and there the companies are like very conservative. So
And that's the problem is a lot of
there
them
are,
just hoard cash. They don't return capital.
yeah, exactly. So a lot of them are like mid caps. I'm not talking about like big caps like Toyotas and Sonys, but they have a lot of mid caps and industrials, which would be like niche player in their sector. They would have almost no competition. They would be selling like machine tools and something like that, and they would have huge cash flows, but then they would not be reinvesting those cash and just would be hoarding those cash in their balance sheet. So on a net asset basis, they look really cheap. Now, why they are cheap? I mean, people have been scratching their heads since last 10 years. So that is your proof that the people who say, the stock market goes up just because of QE, that is your the counter argument. Because if had it been the case, it should have been also the case also in Japan. I think a lot of dynamics in US are due to stock buybacks, because you would have activists come in and they would pressure companies to buy back their stock using the cash out. That doesn't happen in Japan, so that is the way I think.
All right. I want to end then on some fun speculation in the last 10 minutes. I know we already asked Joe his thoughts. I shared some of my thoughts. For the other speakers on the panel, if you're willing to humor me, what do you think about Mr. Cohen's cryptic tweet? Again, just to kind of say, I'll say it out loud if you didn't read it. He tweeted on, what was it, Wednesday after the close, quote, "I just got off the phone with what was once a great American brand. Lots of problems, no accountability for high-paid execs, and little interest in my help at no cost. This could get interesting." Any willing speculators on what company he might be referring to?
I want to see Chris get in the Wall Street Journal again, giving his thoughts on this one.
Yeah, for sure. Congrats, Chris, on being cited in that article in the journal.
Well, thank you. I'm just I saw the interviewer, the
He's getting too
author.
big for us.
I saw the author on Twitter. He asked for some investors in Bed Bath and Beyond and asked for their opinion. And I don't own the equity, but I own the debt, so I decided to reply to him. But with regards to Ryan Cohen, I think it could be maybe something related to Nordstrom. That's what some other people are saying as well. But because he was rumored to have purchased a stake in Nordstrom, and I believe he visited the Nordstrom family up in Seattle, but I'm not sure exactly when or if he did. But
is Nordstrom really a great American brand?
Gap? Could it be Gap?
It's been around for a while here, and I don't know. Is it Danish though? How Danish is Nordstrom? Or Norwegian? Where are they from?
No, they're Seattle-based. I think they're Seattle.
Yeah.
The
they've been here forever.
The family owns like 32%. So unless it's a strategic deal with the family, and they've been trying to take the company private, they've talked about their interest in doing that. So unless the family is involved, this is not happening.
Yeah, they've been trying to do that for a while. I remember back in 2020, they tried to take it private at like $50 a share, and the board rejected it. So
I can jump in and speak to Nordstrom's. I was in Seattle. Yeah, they've been around for a long time. So they actually started, they are a great American brand. They started when America was pursuing up north mining. So they created like boots and sold apparel to miners going up north for gold. They're a pretty big brand. They're good.
And I know it was the Wall Street Journal that initially had that reporting in February, but the company denied it. But the connection, I think, is that Cohen clearly has a bone to pick with Mark Triton, the former Bed Bath Beyond chief executive, who's the head of Nordstrom's compensation committee. So that makes sense, right? I think it's probably the most likely. Now, I'm not a Nordstrom, I guess, shopper. So, I'm in the other side of the country. We don't have maybe as many Nordstroms where I'm at, but no, that's a good point, though, Amanda. That I know the company, from what I was looking at, was like right around the turn of the last century. So I know that the late 1800s was the Klondike Gold Rush. So out of the Pacific Northwest, that makes sense that if they kind of came about supplying prospectors and adventurers and the like.
I think another thing to think about is not only do they just have the Nordstrom stores, they also have Nordstrom Rack, which services, a lower price point shopper. So if we're coming upon recession times, that will probably expand and become bigger.
Yeah, I think it makes sense. Cohen has been all about the e-commerce, and like Nordstrom's e-commerce has, not been, too stellar. There's still a big department store brand, So, getting that omni-channel mix, recipe right, I think it's still been kind of tough for them in recent years, even with COVID. But yeah, anybody else have any idea what he might be referring to?
I say it's greater than 1 in 20 chance that it's in fact Playboy. Selfishly.
Yeah, in terms of American culture, I think Playboy has had a lot more impact on people than Nordstrom. For better or for worse.
I'm sure most people have more people probably have an opinion one way or the other on Playboy versus Nordstrom. I will say, just going back to the reporting on it from February, the reporting was that he had become a top 5 non-family shareholder, that he believes the company can cut costs additionally through targeted board refresh. He admires their attention to customer service, which makes sense. That's been kind of his wheelhouse from day one with how they approached Chewy. And the Mark Triton piece, it does make sense, but we'll see. Jeffrey, what's up, man? Go ahead.
No, before you guys answered Nordstrom's and with all the facts that you bring in, it obviously sounds like Nordstrom's. But if it was me just throwing a great American company out there that's in trouble, I would say Budweiser. I'd say Bud. But that's just
boy.
from current events. So I'm completely, yeah. Anyways, there was.
Altria can't catch a break. They're going to write down their Bud stake next after Jewel.
The question, did you guys talk about the banks in the earnings?
We talked a little bit about JP Morgan's. We didn't really go into too much detail. We were going to wrap up in a couple minutes here, so I probably don't want to open another can of worms. But yeah, a lot more bank earnings to come. So once we start to get more, it'll maybe paint a better landscape of where things are and how much damage has or hasn't been done and how much credit has or hasn't or won't contract and tighten. We did talk about that one survey data point showing a significant tightening in credit conditions. So we'll see what happens. But last call then for folks who want to maybe humor the question about Mr. Cohen's tweet before we'll just wrap up around 6 or so. JM, did you want to chime in on that, or was it something else?
Can you hear me now?
I can.
Thank you. So my question is kind of related to banks. It's a very simple question. I wanted you guys' opinion. There was a article published which JA, the Special Situations Research Newsletter, they republished. Nikki T, I don't know who that is, but the chart showed that the deposit changed since January 2021. It was the chart. And it showed that both small banks and large banks, the outflow of deposits seems to be about the same. Basically, it went for the small banks from $16 billion to roughly $10 billion for small banks. And about the same time period, it went from 10 to $4 billion. I understand the percentage probably is less, but it appears to be the same, but small banks are being beaten a lot more than big banks. So what do you think of that is my question.
So I think you were referring to Nick Timmeros at the Wall Street Journal. He
Correct.
said
Yeah,
Nick
that's
T.
right.
Okay, yeah. Yeah, yeah. I have the article up for folks looking at my screen from his reporting last week on it. And yeah, I mean, really, it's. I think it's like one of those things where you had a light bulb that was shined on the reality that what banks are paying depositors relative to what depositors could get in other risk-free assets. There was a massive gap after the last year's rapid hiking cycle. And
Correct.
since that light has been shown, right, you've seen massive capital outflow into money market funds.
Right.
I think money market funds have risen several $100 billion in the last few months.
Month.
So that'll probably continue, right? Like all else equal, as long as rates stay like this, banks will have to slowly edge up what they're paying for depositors, and it's going to vary by bank. The GSIBs likely don't. J.P. Morgan, Wells, Citi, BAC, they're going to keep paying a few basis points, and I don't think that it's going to matter for them as much, which is, I think you could argue, an unfair advantage, right, that they kind of have over the regionals and their other peers. But frankly, I don't.
My
It
primary
doesn't.
question is that they have JPM has more muscles to flux. I understand that as the top
Right.
bank in the country, but it seemed all rosy today when that's how they painted the picture today when the banks reported the earnings. At least the three of them: Wells Fargo, Citibank,
Right.
Citigroup, and JP Morgan. I'm thinking about other banks that are lined up to report earnings in the next week and later. I was talking about, for example, like PacWest or another regional bank, First Republic, which has been beaten so heavily. It seemed to me that the issues are comparable because people were worried. I understand about the issue with the commercial real estate related issue, but
Right. You got to think though. A lot of the First Republics, the PacWest, like they're probably gonna have to raise capital, and it's like it goes back to what ended up sinking SVB was that they effectively were trying to raise capital. They were trying to do it in a way that didn't maybe terrify the market, and unfortunately, word got out, and we saw the bank run with rapid dissemination of information from the consolidated depositor base, all in their Slack channels. So, like, I understand why people are attracted to the First Republics, the equity or the preferred stock, or PacWest or others like that. But I've been saying since this began that unless you are a bank analyst and you have expertise and you've really gone through the bank's balance sheet and understand what it has, what its assets, liabilities, whatever, like that it just because something dropped a lot, right? Like don't see that as an opportunity to buy. And in these banks' cases, I certainly don't think for many of them it is an opportunity. Unfortunately, the long-standing equity holders, many of them are going to have losses they never recover from. I mean, you look at the FRB chart, and it's like that day in the life of a turkey chart. It keeps going up and to the right until it falls off a cliff. So,
Right,
yeah,
right. I mean, yeah, I agree with you that they have to raise the capital. What I heard was that $30 billion have been deposited roughly by major banks, and they also mentioned that they are going to stop paying dividends for the preferred stocks as well as the origin. I mean, the commons. They mentioned that a while ago. I'm trying to wrap this around my head and see, like, given that it felt so hard so long, I mean since March 10th, and it's currently hovering around low $13. I was kind of wondering, is there an opportunity there at all, or it's the risk outweighs the opportunity is what I'm trying to understand, given that the earnings are fast approaching for these regional banks. But you kind of answered that question saying that
yeah.
unless you are an analyst looking at the bank balance sheet, okay, I think I'll wait and see how this whole thing evolves. But that's my question, and thank you so much for the time.
And you know what, Jay, and thank you for the question. So one other thing I would kind of comment in that vein is I do know that some people opted to play the volatility around the banks, where instead of maybe taking a position in the common stock or in the preferreds outright, maybe they saw the explosion it implied in price volatility and opted to say right and at the money or near the money put contract, or maybe they did a buy right. So I know that a lot of that volatility has dissipated since what it got to when there was even more uncertainty, right?
Mm-hmm.
So that would be a way that maybe you could dapple in and out, right? Is if you want to try and monetize volatility, but that's a whole nother can of worms, as I'm sure
Right,
you're well
right, right.
aware.
I know. But even the volatility nowadays is pretty much it's flat nowadays. It hardly moves on either side. So there's not much you can capitalize unless there is something they are going to say strongly, which would
Yeah.
move the stock one way or the other, which we do not know until after they say whatever they are going to say during the earnings. But
Right. I'm
um,
looking at the First Republic Bank, what was priced in the 30-day implied volatility, it looks like got up over 200% earlier this month, a couple weeks ago. But now it looks like the 30-day vol has actually been slashed by more than 2/3 since
pretty
then. So
flat.
the opportunity looks like it was
Yeah.
gone. But to me, that would have been the opportunity, is to step in and maybe bear some of that risk. But it's a lot of risk,
Yeah.
right? Like some of these banks, it was a matter of the next morning it's not opening, and you're wiped out. So a
Right,
lot of
but the
a
other
lot of
way I
risk.
want to see it is that how much more can it fall?
It can go to zero.
Oh, I don't know if Fed is going to do that, given all the scariness. But we are kind of out of we are
I mean, equity can go to zero. Equity went to zero in these other banks. Bonds could go to zero, right?
right. I
The
mean
depositors are
that's
going to be protected. It's pretty clear that the Fed and Treasury and FDIC will do what they need to protect depositors, and that's the message that they and Buffett and everyone is really trying to reinforce, is that depositors don't need to pull their deposits and put them in mattresses. But the equity holders and the bond holders,
well. If it goes to
they are not
zero, then
being
shorting it is a
bailed
great
out.
opportunity, or buying puts is another opportunity.
Oh yeah, I mean, I know plenty. Let me not say plenty, but I know a nice chunk of people that were fortuitous in buying Silicon Valley Bank and the other whatever the other two were, puts that they got a max payout on. So good for them. Um, but yeah, it's definitely a very high risk.
Well, at this
Are you
point, I
being are
guess.
you being compensated appropriately for the risk you're bearing? Is kind of how I would always go back to it. And unless I had some deep insight into one of these financial institutions and I felt like I knew better than the market, because here's how I would put it too. A lot of tickers, and I've used this example before, tickers that were not banks, that were financials, got dinged. So there
Right.
were players like, say, Virtue, the market maker, that
Mm-hmm.
got dinged big time,
Mm-hmm.
VIRT. And when you look at the VIRT, stock chart, you see it got down to basically levels close to not GFC, close to the trough in early 2020.
Right.
But then the company, they're not a bank. They weren't really impacted by this. The company actually came out in March and accelerated their share repurchase, and were basically buying shares hand over fist for the balance of the quarter. So that price has recovered a little bit. I still actually think it's pretty undervalued, but it has its own idiosyncratic regulatory risk. But like, just speaking generally, like if you see that the financial sector was getting crushed, I would have looked for non-banks that weren't really being impacted, that were being sold off just because of being part of the wrong sector or wrong factor, right?
Right. Right.
That to me seems like easier than trying to maybe go in and pick the right bank
Directly.
and not lose my shirt.
Yeah, but what's interesting to me is that JPM has some stake in First Republic, is what I understood. It wasn't a large stake, but some single digit percentage they have stakes in First Republic. But anyway, I think it's too hard to guess at this point, and we have to just wait and see. And whatever risk anyone is going to take at this point is, it's it may swing either side. We do not know. So whoever wants to do it, they should be ready to lose money. And if they make a bank, good for them, I guess.
Yep, and I know plenty of successful investors who don't invest in banks, and you know
Okay.
what? You don't have to, right?
True,
so
true.
so
Yeah.
but thank you for the questions. I know we wanted to wrap, and I know a couple other folks had come up as a speaker. So
Yeah,
if
please
I'm
go
gonna
ahead. Thank you so much for your
thank you,
time.
JM.
Yeah, appreciate it.
I saw that GA you came up, and then I'll get to Kerrang after.
I had missed the first hour or so, so I don't know if it was all already covered. So I beg your pardon. But Sir Jack-a-lot, he's back into degenerate gambling, and he bought that NVDS, the inverse NVIDIA. You know, if that had all already been discussed,
We did
then
not
please
talk
let me
about it.
know.
Look, I think I've said this in a few venues. I'm not a fan of leveraged ETFs for anything more than a day trading tool because you're going to get eaten alive. I mean, the 1.25 times maybe isn't the worst of them all, but these leveraged ETF products are not meant to be bought and held. They're just trading vehicles. And this one has a
Oh
pretty
yeah,
hefty
I know
expense
that they're like
ratio, right?
hold for a few days, maybe a week.
I could see a use case for a vehicle like this if you are trying to, say, short NVIDIA, but you have only the ability to get exposure in a retirement account and you can't short outright, which I, in my personal accounts, kind of have that. But he's obviously got his startup and he's doing his best to tout that and his after hours business. So I think it's probably just as much him having fun as much as him trying to bring attention to what he's trying to bring to light, which is a neat little product. But yeah, NVDS as a vehicle to me is not. I would just short the common if I really wanted to be short NVIDIA. And we've I think talked about this, right? Just because the valuation seems kind of crazy on next 12-month basis of sales, earnings, etc., in the context of current operating results. There's clearly a narrative going on with NVIDIA. They are clearly the biggest GPU player, and clearly GPUs are going to be an essential component of AI compute. So I would I would not fight it, right? Like I would wait until maybe the narrative dissipates or the trend inflects rather than trying to fight it. I in my personal account don't have much exposure. I have some put spreads that are out of the money for January on NVIDIA, but it's a pretty small allocation. But prices can go crazy, as we've all seen the last couple of years for a long period of time. So GA, yeah, that's about it then. Hopefully on that front. Kerrang, what's up, man? Please go ahead. And then we'll wind it down.
Gotcha, buddy. Yeah, banks reported net interest income, right, has been good for the bigger banks, obviously JP Morgan. What I did find interesting in the earnings call, right, their CFO, like you were speaking about earlier, when it came to those money market funds, he still sees the flow, maybe not short term, but going out towards the end of the year, still increasing there. Right, Jamie Dimon had a little bit different of a tone when it came to his overview of regional banks. He thinks they're going to surprise to the upside, and why I wanted to say that going into earnings, as we all saw today, FactSet was showing overall, right, market analysts were expecting 6.8% negative EPS, and then only 1.8% revenue growth. So top and bottom line was interesting. So yeah, dollar weakness might help some of that exposure, especially on the tech front, since a lot of those S&P 500 companies, as you know, as most of us hopefully know, do operate outside of the United States. So there's that narrative that analysts might be a little bit late this time as well. I'm sure we'll still have some earnings revisions downward, but there might be some bright spots still left, right? We just started earnings season, so sometimes that narrative is going to shift. Obviously, we have building permits and some housing data coming out next week. We have the rate decision right coming up a little bit further out towards May 3rd. Obviously, Waller spoke today along with another FOMC member. There's voting, taking more of that hawkish stance. So we did see the market react to the retail sales numbers along with the Michigan consumer sentiment data. And then we saw that nice little recovery going into the close. However, let's see what next week holds. I still think if you take a look on a weekly time frame, we're just stuck in a range still. Even if you look out further on a day time frame when it comes to the technical side of things, that 41.55 level on SPX seems to be of significance to hold. So let's see what happens with the rest of next week and the rest of earnings.
We also, volatility plummeted again today. So we're at a 17 on the VIX, which is just incredible to me.
Yeah, I think Mark Newton, who's also believe he's at Fundstrat now. It's 18-month low, so it's nearing the lowest level since January of 2022.
Yep.
That's when SPX had peaked out, right? So front month futures, basically. He just shared this about 2 hours ago, meaning VX futures, just so everybody's clear on what we're talking about. They've been squashed ahead of expiration, but it's still early to buy vol, according to him. And then VIX remains a head scratcher, which is odd, like you're stating, to those that don't understand how implied volatility basically works. So, as you know, the VIX is a culmination, right, of the S&P 500 constituents when it comes to their implied volatility. So, yeah, that's also an important point right there. However, when we reach this area, if you take a look, and this is going into even February, right, of this year. This is also where we started seeing that reversal upward, right? If we're also looking more year to date. So I can share this up top so everybody can see what we're talking about when we're talking about the VIX and the volatility, just to give you as well as everyone else a visual. So it should pop up there up top. I'm not going to take any more time. Like you said, you're trying to wrap it up, but thank you for the time.
Yeah, thank you. Okay, so it's Friday. It's 6:17. We started this at 4. Just some programming notes for everyone. As I alluded to, we have some exciting changes coming. I won't use any other words than changes coming, and we'll communicate all of those through the different social media platforms. So be sure that you're following both the @Wook Capital handle. Give Joe's handle, his personal handle, a follow. If you're not following Joe, you're welcome to follow my personal handle @Rod Alsman. And we'll be sure to disseminate that information once we're ready to publicize it. We'll continue hosting these Friday calls at the close. So appreciate the active engagement today. Thank you, everybody that came up and chimed in on the speaker panel. We really do appreciate it. I mean, I'm happy to talk, right? But I much prefer to get different people's perspectives. I enjoyed our little crowdsourced research spotlight on Kyle there when we were talking about some of the work he's done on American Manganese. Really just gets to the real reason that Wook Capital even exists. We exist to foster crowdsourced research and hopefully achieve investment alpha as a byproduct of that crowdsourced research. So we appreciate everyone's interest in our programming. We will keep doing our weekly open mics on Wednesdays. So we have had a good turnout on Wednesdays at 7 Eastern. We start those off. We usually run them till at least 9 o'clock. They have run till 11 or so a couple times. So those are usually fun. They get lively. Monte, appreciate you joining often, and Chris as well. It's been some real good ones of late. Real good defense discussion this last week. So please check those out and join our Discord. Like you see the people on Twitter spamming their Discord links. We try not to be too spamming. Where again, as I've kind of made clear, we're very uninterested in very short term stuff. we're much more interested in long-term strategic investing and trying to realize investment alpha over a longer duration than a lot of the folks in social media are. So yeah, we hope that folks found this informative, entertaining a little bit, engaging, and yeah, please be on the lookout for more news and updates from us. And we hope everybody has a great weekend. So thanks for your interest in Wook Capital, and we'll talk soon, everybody. So cheers. Be safe out there.